Vinod, in the previous session, we looked at the changing finance needs of FPOs based on its development trajectory. We learned about nature of finance required by FPO at different development phases. In the current session, let us look into the various types of finance available for FPOs.
Sounds good.
Now, in this session, let us try to understand different types of internal and external finance options for FPOs. Vinod, what are the different types of finance your FPO needs?
Our FPO needs grant and loan. The funds may be mobilized internally from members or from banks, other financial institutions, CSR foundations, etc.
Vinod, as you rightly mentioned, a FPO is dependent on multiple sources of finance. Let us look more into this. A FPO is dependent on long-term sources such as own funds, equity, grant funds, non-repayable, loan funds, debt, trade credit, emerging models, blended finance, bridge finance.
Oh, so many options.
Grant. A grant can be an award, non-repayable fund given by one entity, typically a company, foundation, or government, to another entity to facilitate a goal or to incentivize performance. In the case of FPOs, grants have been made by the central and state governments through agencies like
SFSE,
and NABARD and government departments initially to set up and develop the FPO. The grant term is 3 to 5 years, and one of the project goals is developing the small and marginal farmers and their income. It is a long term financial assistance provided to achieve a particular development goal.
Do these grants need to be returned back?
Grants need not be returned back. It provides assistance for initial startup and setting up of new business. Provision of grant is tied to certain conditions.
Okay, it is useful for the initial setup.
Now, let us learn about another instrument, equity shares. Equity. Equity shares are the share capital of the members. It comes from the contributions made by members in the FPO and is an internal source of capital. Capital size through internal mobilization can be increased through increase in membership, modifying the share value, etc. Raising of equity shares from members can further attract equity grant from external agencies. Vinod, what are the different types of loans?
The different types of loans are working capital loan, term loan, and cash credit limit, etc.
Yes, let us discuss about it. Loan or debt. Loan may be in the form of term loan, working capital loan, and cash credit limit. Term loans are for creating long-term assets, setting up of processing units, purchasing machinery or tractor, constructing godown. Working capital or cash credit limit are for meeting day-to-day requirements of the FPO, buying raw material, operating input shops, processing units. Cash credit limit is the provision made to withdraw money beyond the approved credit limit, even if there is no balance. It is a short term credit facility. Working capital has a short term limit, 1 year. Term loan has a longer tenure. Duration may be short term, less than 18 months, and long term, more than 18 months. These are usually provided by the commercial banks, RRBs, cooperative banks, NBFCs, and small finance banks. Loans are provided based on analysis of past credit history, current performance, and future potential. Loans come with terms and conditions and could be secured or unsecured.
Okay.
Vinod, have you purchased goods on credit?
Yes. I used to buy goods and pay it back to the seller at the end of the month.
Yes, this was a business to consumer transaction. But if it happens business to business, it is called trade credit. Let me explain. Trade credit. This is a way of commercial financing in which a business may purchase goods or services and pay the supplier at a later scheduled date. The period of payment could be 30 days to 60 days or as per the agreement made. The vendors or suppliers, in effect, have loaned the company money.
Yes, I can correlate with my example. So it is a purchase for which payment is made later.
Do you know of support provided through blending of public and private finance?
In my village, to improve food provision in midday meal scheme, CSR provides money to the school. This is in addition to what they receive from the government. Through mix of both, the size of finance increases and as a result, better services are provided.
Yes, blended finance is something like that. Blended finance. This involves merging of both public and private finance. Merging leads to increased availability of development finance. The increased finance can be used for strengthening FPO business operations, such as creating production, processing infrastructure, etc. Investment risks are reduced as there is sharing by both government and private sectors.
Okay, I understand. In this model, both public and private sector join hands to extend support.
Vinod, what is bridge?
Bridge is something which connects two different points and helps reach from one point to the other.
Bridge finance. This type of finance is a stopgap arrangement to address finance needs between two different loan periods. For example, a loan is available for the period January to June, and the next loan can only be available from October onwards. But there is a need for loan during July September. The finance need met for the July September period is bridge finance. Bridge loans are short term, typically up to 1 year. Bridge finance is quickly processed, provided with minimal paperwork.
So, bridge finance helps in maintaining business activity by addressing the finance gap between different loan periods.
Now, let us look into warehouse receipt finance. Warehouse receipt finance. These are the loans which can be availed based on the value of stocks maintained in the warehouses by FPOs. A FPO in need of loan from bank can take warehouse receipts from Warehousing Development and Regulatory Authority WDRA accredited warehouses against the stocks placed in warehouses. This warehouse receipt can be used to get credit from banks up to 70% of the collateral value. FPOs can access debt secured by the receipts either from banks, commodity exchanges, or electronic agriculture markets. Once the produce stored in warehouse is brought by the buyer and paid to bank, the warehouse receipts are released. All the major commercial banks, both public and private, provide loans against warehouse receipts.
Okay, I understand warehouse receipt finance. These are loans advanced against the warehouse receipt issued against stock maintained.
Vinod, can you summarize the different types of finance?
There are various types of finance, including grants, equity, loans, and trade credit. There are also new emerging models such as blended finance, bridge finance, supplier credit, and warehouse receipt finance. Each of these have its advantages and disadvantages and help in addressing specific challenges during the evolution of a FPO. A FPO needs to raise finance through mobilizing different finance options as available. Grants provide initial support in incubation phase, equity, and loans in growing and matured phase. Blended finance replenishes FPO finance due to collective financial strengthen from both sources. Bridge finance provides for stopgap arrangements. Warehouse finance provides loans against the value of stored goods in warehouses and value mentioned in warehouse receipt. The table describes the types of finance discussed.